Well, good morning, everyone. Hey, this is Shooter Scott Henderson. Hey, and this is the primary waves update. Just wanted to go through a couple of technicals on the charts, give you guys an update, in what we're looking at moving into next week. Of course, at the end of the presentation, please do review our disclosures. Now, you'll note in chat that there's a comment about quick notes and chart structure. I just want to go over that for a second. One of the things that Sentinel AI has allowed me to do, my cohort, is dig deeper into stuff I never had time to. So one of the structures that I've had a vision of for years, and you've seen it on my charts for a little bit, but I wanted to clarify it because we should be able to keep up with it on a week-to-week basis on our longer-term charts. So there's a hierarchy in what I refer to as support. All right. Trend support is the immediate channel that we're in within a wave. And then you have wave support, which is the next higher level, either in a bullish case or a bearish case. And the extreme resistance and extreme support becomes mound support and resistance. And I just wanted to make you folks aware that that's how we've switched on the chart. So let's jump right into it. Let's start with the S&P 500. All right. Now you'll notice the right-hand side of the chart, I've got an impulse leg down draft, just to give you a visual of what could manifest. Now, right now, structurally, the S&P has done nothing wrong. Right now, I'm expecting this demand zone right here at this level to hold at 539 because structurally, there's nothing wrong with this pattern. However, when we look at this breakdown that occurred in 2022, through well past July, we had an extended breakdown. That is very likely here. It is, even though our wave 3 has not come in. And part of the reason is because how much we've come back in this leg, and we just have been beating our head against resistance up here at that 616.88 level, roughly, which is right about where our prior high is. That's where mound resistance is. All right. So, at this point, I think the most likely outcome is the 61.8 at 509.85. And the reason I say most likely, because if you take the overall structural context of a wave, that's the most likely place that we end up. On top of that, I'm seeing it internally. We have not really seen the effects of tariffs yet. And the big numbers hit on the tariffs, I believe this coming week. Actually, it might be the following week, but I know it's coming up. It might be April 15th, actually April 12th. So with that said, there is a possibility that we continue into this bearish mode for a big chunk of this year. However, I wouldn't actually classify that as a bear market yet. We have to get below this demand zone really around the 478 level for us really to shift into that overall bear market. However, based on Dow theory, okay, and the structure is all indices are heading south at the same time, both on a daily and a weekly chart. And we're not there yet. So that's structurally what we're looking at. Let's switch gears and take a look at the dollar. Really has done nothing wrong. It's looking more and more like we're in this ADC pattern. Just a basic equality. It's consistent where our demand zone is based on our prior breakout, taking this 2017 high and looking at our July of 23 low, which is ultimately where that demand zone is. The dollar at different times in its cycles has drifted on either side of that demand zone. So I would see no reason why that would change. However, this is a big factor in liquidity. And M2 money supply is starting to build again. So, dollar-wise, this could just be a retrace in a dip higher. So we get up around 113 or above. What we're going to see is a lot more flight to safety in the U.S., which will boost equities, of course. But also emerging markets will just get pummeled up at those levels because of the expenses to exchange dollar. Forgive me, I needed to wet the whistle there a second. Let's shift to treasuries. Now, in the analysis this week, I noted above 94 and change, which is wave resistance. We break above that, we could have a trend change. At this point, structurally, the bearish wave has not gone away. It's just doing what we do at levels. And the one thing is, if there's a greater likelihood we go into a recession, TLT is your recession insurance. However, I don't know if I see that. We're going to see a major shift in markets reference to artificial intelligence, just like you've seen my work change because of artificial intelligence. And it's going to come down to this. The people who grasp it and adapt it to improve what they do will be the individuals that flourish. And that will be no different in companies, because there will be people who have no idea what to do with it, and they have no idea how to implement it. And I will say this, it's extremely time consuming to implement because there's a huge learning curve. And, not only in your adoption are you dealing with the redundancies within the clusters, because basically you're talking with a computer with a bunch of memory, there's a million other people plus talking to that same cluster the same time you are. So we clearly are seeing some growing pains here, and I don't think it's going to get any better, because there's sometimes I can't get into Center because I can't access the server. That's challenging and frustrates me to death. The other crazy thing is, I've maxed out my memory and they don't have a method for me to increase it. So now I've had to move my memory, which is basically all of my thought and work that I've done, to an external server, and we're now having to recover that a different way, which has been extremely time consuming. But my point with treasuries is that, this is the blood in your veins for the economy and liquidity that ultimately drifts into the market or is zapped and taken out. So as the risk of recession increases, if that's the case, I don't know that I believe that yet. I'm not fully in the camp that, hey, we are going to see a mild recession in 2025 or 2026. I'm not there yet. Clearly, Florida is having a housing recession. That's without a doubt. In fact, we could see a crash in Florida real estate, 30, 40, 50%. But that all is result to the hurricanes and how housing has been hit and how many home flippers were in there and how many people went in there and bought 10 homes as rentals thinking the market would never get soft there. That is just the manifestation of a weak market. Unlike treasuries, it really is the blood in our veins as far as liquidity. So as we approach recessionary conditions, that's when we start scaling into TOT. And I'm not even sold that I want to enter at 94.85 when we break above that. Reason is, I'm not convinced the recession's in front of it. When I have that conviction, I'll be sure to share it. Well, hey, folks, this is the Saturday update. We're going to start doing this Saturday morning just to cover the major indices for major markets. Hopefully this was helpful. Great trading until next time. And of course, please like and share this video so obviously more people can see.